Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hilton Worldwide Holdings Inc. Annual Report. Hilton Worldwide Holdings Inc. offers a diverse range of businesses and services through its hotel management and franchising operations. The company's portfolio includes various brands catering to different segments of the hospitality industry. The management segment comprises luxury hotels, such as Waldorf Astoria Hotels and Resorts, LXR Hotels and Resorts, and Conrad Hotels and Resorts. Lifestyle hotels like Signia by Hilton, Nomad, Canopy by Hilton, Graduate by Hilton, and Tempo by Hilton are also part of this segment. Focused service hotels include Motto by Hilton, while All Suites hotels are represented by Embassy Suites by Hilton, Homewood Suites by Hilton, and Hometuo Suites by Hilton. The franchise segment features a range of brands, including Doubletree by Hilton, Curio Collection by Hilton, Tapestry Collection by Hilton, Outset Collection by Hilton, Hilton Hotels and Resorts, Hilton Garden Inn, Hampton by Hilton, True by Hilton, Spark by Hilton, and Hilton Grand Vacations. The company also operates the small luxury hotels of the World and AutoCamp brands. In addition to its hotel management and franchising operations, Hilton Worldwide Holdings Inc. offers timeshare services through Hilton Grand Vacations. The company's loyalty program, Hilton Honors, rewards customers for their stays across various Hilton properties. With a global presence in North America, South America, Central America, Europe, the Middle East, Africa, and the Asia-Pacific, Hilton Worldwide Holdings Inc. provides its services to a vast customer base worldwide. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause Hilton Worldwide Holdings Inc.'s stock price to increase in the past year. Hilton Worldwide Holdings Inc.'s stock price has increased significantly over the past year due to several factors. One major reason is the company's strong financial performance. With a significant increase in revenue and net income, investors have become more confident in the company's ability to generate profits. This confidence has led to an increase in demand for Hilton's shares, causing its stock price to rise. Another factor contributing to the increase in Hilton's stock price is the company's strategic expansion plans. By expanding into new markets and increasing its presence in existing ones, Hilton has been able to tap into new revenue streams and improve its market share. This growth strategy has not only increased the company's revenue, but also improved its profitability. Additionally, Hilton's focus on digital transformation has also contributed to its stock price increase. The company's investment in technology has enabled it to improve its customer experience, increase efficiency, and reduce costs. This shift towards a more digital business model has made Hilton more competitive and attractive to investors. Lastly, the overall improvement in the hospitality industry as a whole has also contributed to Hilton's stock price increase. With an increase in travel demand and a rise in consumer spending power, companies like Hilton have been able to benefit from this trend. As a result, Hilton's stock price has increased significantly over the past year, making it one of the top performers in the industry. In conclusion, Hilton Worldwide Holdings Inc.'s stock price has increased due to its strong financial performance, strategic expansion plans, focus on digital transformation, and the overall improvement in the hospitality industry. These factors have combined to make Hilton a more attractive investment opportunity for investors, leading to an increase in demand for its shares and a rise in its stock price. Hilton Worldwide Holdings Inc. market capitalization of $78 billion is significantly larger than the average industry peer of roughly $11 billion. This shows that Hilton Worldwide Holdings Inc. holds a significant advantage in their industry. Hilton Worldwide Holdings Inc. trades at a higher price-to-earnings ratio of 48 times and a lower price-to-book ratio of -15.67 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 122% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for Hilton Worldwide Holdings Inc. can be attributed to several key factors. Firstly, franchise and licensing fees have seen a significant increase of 6% from 2023 to 2024, contributing to the company's revenue growth. Additionally, incentive management fees have risen by 21%, while cost reimbursement revenues have increased by $657 million during the same period. Furthermore, total revenues generated from various countries have also shown an upward trend, with a notable increase of $744 million in U.S. revenue alone. Licensing fees from strategic partnerships, including co-branded credit card arrangements, have also contributed to the company's revenue growth. Advance consideration received from hotel owners for application and system implementation fees has further boosted Hilton's revenues. On the other hand, some factors have led to a decline in revenue. Base and other management fees remained relatively flat, while capital costs for FF&E and leasehold improvements decreased. Changes in fixed lease payments, as contractually stated in the lease agreement, have also resulted in a decrease in revenue. Net income for the company experienced a decline in most years from 2023 to 2025 due to various factors. The primary reasons include reduced customer demand, increased labor costs, higher operating expenses, and decreased base management fees. However, there was an increase in net income in 2024 compared to 2023. Nevertheless, this growth was short-lived as the net income dropped by $78 million from $1,539 million in 2024 to $1,461 million in 2025. Profit margins also witnessed a decline in most years during the same period. The main reasons behind this decrease were reduced profitability of hotels within ownership segments, increased fixed expenses, difficulty adjusting portfolios in response to economic changes, and decreased net income. Interestingly, profit margins for the management and franchise segment saw an increase in 2025 compared to 2024. However, both plans experienced a decline in profit margins in 2025 compared to 2024. The reasons behind these changes are multifaceted and can be attributed to macroeconomic conditions such as inflation, interest rates, and supply chain disruptions. Geopolitical activity and public health concerns like COVID-19 also played a significant role. Additionally, decreased corporate or government travel-related budgets and spending further exacerbated the decline in net income and profit margins. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided information, the net cash provided by operating activities has consistently been in the positive range over the past 3 years. In 2025, the company generated $2,129 million in net cash from operating activities, indicating a strong ability to produce cash from its core operations. This trend is consistent with previous years, where the company generated $2,013 million in 2024 and $1,946 million in 2023. The steady increase in positive operating cash flow suggests that the company's business model is efficient and effective in generating cash. Overall, the data clearly indicates that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past few years. Initially, the total debt level increased significantly from $611 million in 2026 to an aggregate of $14.9 billion after December 31, 2026. This increase was largely driven by the issuance of senior notes, which added $2.5 billion to the company's debt level. However, this was partially offset by repayments made under the revolving credit facility, resulting in a net increase of $1.625 billion. In terms of long-term debt, the numbers show a more nuanced picture. While there were increases in 2024 and 2025, with long-term debt rising from $11,119 million to $12,1 $119 million. The most significant jump occurred between 2024 and 2025, when it increased by $82 million. On the other hand, interest expenses have shown a different trend. Initially, there was a decrease of $51 million in interest expense from 2023 to 2024. However, this trend reversed itself in 2025, with interest expenses increasing by $51 million from 2024 to 2025. The overall change in interest expense between 2023 and 2025 was an increase of plus 34%. The performance of various segments and regions within the company has been mixed. On a positive note, the management and franchise segment has shown significant growth, with a 15% increase in Hilton Honors members and a revenue increase from $3,055 million in 2023 to $3,575 million in 2025. However, other segments have struggled. International operations are exposed to various risks such as changes in government policies, economic downturns, and natural disasters, which can negatively impact business. Additionally, international markets are affected by corruption and anti-corruption laws, making it challenging for the company to operate effectively. The ownership segment has also seen a decline in revenue from $1,255 million in 2024 to $1,233 million in 2025. Furthermore, leased real estate investments have faced increased costs, reduced profits, and limited ability to respond to market conditions. These underperforming segments pose significant challenges for the company's overall growth and profitability. Management is optimistic about the company's outlook, highlighting several key strategies that will drive growth and success. The primary focus is on expanding the global hotel network through a robust development pipeline, which will increase brand visibility and attract new customers. To complement this expansion, management is prioritizing customer loyalty by investing in strong brands, dedicated workforce, and commercial service offerings. This approach aims to create long-term value for stakeholders while strengthening business resilience. The company's Travel with Purpose strategy is also a key driver of its growth plan. By reducing emissions, water, and waste intensity at hotels, partnering with corporate customers on sustainability goals, and combating human trafficking, management is demonstrating its commitment to creating positive environmental and community impacts. In addition to these initiatives, leadership development programs are being implemented to build effective leaders who can drive business success. The company is also considering strategic acquisitions and investments in hotel or hospitality brands, as well as other businesses and properties. Overall, management strategy is centered on growth through expansion, customer loyalty, sustainability, and strategic investments. By prioritizing these areas, the company aims to create long-term value for all stakeholders while driving business success. The company has made several strategic moves in terms of acquisitions and divestitures to shape its business landscape. In the realm of acquisitions, the company has engaged in a merger with no specific details provided. Additionally, it has acquired management and franchise, contract intangible assets from third parties, which is expected to bring in new expertise and capabilities. Furthermore, the company has made annuity purchases for 2024 and 2025, indicating a long-term commitment to its business. On the other hand, the company has also divested certain assets through sale, closure, or lease termination of existing consolidated hotels. This move is likely aimed at streamlining operations, reducing costs, and focusing on core businesses. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to shareholders. The company has consistently paid dividends as evident from multiple pages in the report, indicating a commitment to rewarding its investors. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares and increasing earnings per share. The presence of share buyback activities on several pages further underscores the company's focus on creating long-term value for its stakeholders. Supply chain disruptions. A growing concern. The current business landscape is plagued by several supply chain disruptions that threaten to impact operations and profitability. One of the primary concerns is the potential for labor shortages, which can lead to decreased productivity and increased costs. Additionally, airline capacity and routes are being reduced, further exacerbating the issue. Another significant concern is construction delays due to a lack of availability of required materials or cost overruns related to necessary capital improvements. This not only affects the construction process, but also has a ripple effect on other business operations that rely on these facilities. Severe weather events, climate-related disasters, and outbreaks of disease are also causing disruptions to hotel properties, making travel to certain regions less attractive or more difficult. These disruptions can have far-reaching consequences for businesses that rely on a stable supply chain. That concludes the financial summary for Hilton Worldwide Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.